To this short video on accounting with me, Mr. Woolley. This information is essential for both Year 11 and 12 Business Studies students. Did you know that in the HSC Business Studies final examination, financial management is consistently the worst performing topic? Because of this, the Board of Studies continues to test it every year. In this video, I'll aim to flip the classroom for Year 11 HSC preliminary students and introduce them to the financial statements. At the same time, this video will act as a refresher for students in Year 12. Let's get started. First of all, I know what you're thinking. Mr. Woolley, I don't know anything about accounting. Why do businesses even need accounting? Well, I'm here to tell you that you actually do know a bit about the topic already. If you've ever bought something from a shop, whether that's a good, such as a pair of shoes, or a service, such as a movie ticket, you've probably been given a receipt. Now that receipt you've been handed is actually a record of your financial transaction with the business. Accounting is simply the managerial and administrative tool that involves the recording of the financial transactions. It's where the business gathers and collates every receipt, invoice, e-payment, transaction, delivery docket, and cash register record, and others. Accounting is the process of placing these pieces of financial information into accounts, which are then summarized into the financial reports and statements. The three main accounting financial reports or statements that we need to know are 1. The cash flow statement. 2. The income statement. 3. The balance sheet. The information that is contained in the cash flow statement, income statement, and the balance sheet help a well-trained manager to get an accurate picture of the financial status of the business. These statements help a manager or business owner to run the business more effectively. Let's now look at each statement. Feel free to pause the video at any time to read the statement in detail. Number 1, the cash flow statement. The cash flow statement provides information about the liquidity of the business. Remember, liquidity is the ability of the firm to meet short-term financial obligations. If a business has bills that it needs to pay tomorrow, it will need the cash to pay them. The cash flow statement shows where all of the physical cash entering the business came from and where all of the cash leaving the business went. Next, we have the income statement. The income statement, also known as the profit or loss statement, shows all of the income received and all of the expenses incurred by the business over a period of time. The income statement differs from the cash flow statement as it only has 5 categories. We start with the total revenue from sales, then minus the cost of goods sold. This gives us the third category, which is gross profit. We then take this gross profit and subtract expenses, and we're then left with total net profit for the year. Remember, however, that if this number is negative, the business has made a loss. Finally, we have the balance sheet. The balance sheet reveals the current financial position of a firm. The balance sheet details what the business owns and what the business owes others. The balance sheet is divided into assets on the left and liabilities and equity on the right hand side. It's called a balance sheet because the left hand side must balance with the right hand side. The most important thing to remember about the balance sheet is the accounting equation. Assets equals liabilities plus owner's equity, or assets equals L, A equals L plus E. Let's take an example. Imagine you run a business where you make deliveries using your truck. Let's say the asset, the truck, is worth $10,000 and you have spent $6,000 of your own money or own equity when you purchased the truck. Well, what are the liabilities that you owe? Well, you must have borrowed the remaining $4,000, and so you have a loan or a liability of this amount. As we can see, the balance sheet shows what a business owns as well as what it owes others. In summary, accounting is a managerial and administrative tool that allows the recording of financial transactions so that a clear summary of what has happened to the money coming in and going out can be traced over time. The 3 financial statements are the cash flow statement, the income statement, and the balance sheet. And finally, the accounting equation is assets equals liabilities plus owner's equity. Thank you so much.